2020, we had a fall and then the markets bounced back. And there seems to be no stopping that rally. And over a period of time, we start hearing, sound bites like the market is expensive, the PE ratios are, at unprecedented highs, valuations are at unprecedented highs. And that sort of troubles some of the investors because typically when the market is rising the way it did from March, April of 2020, all stocks and all investments go up, whether they have value or they don't have value. So it's also a time where something which was underperforming previously has now started doing well. There is some profit now on the table. And the worry is that even though I have more money to invest, is there a likely sort of crash and a diminution in value of my investment likely to take place? So people think that, yes, it's a good time to, take money off the table. Of course, for those investors who have requirements of the fund or they are genuinely following asset allocation and finding a higher equity allocation than what they are comfortable with, it's a good idea to pull out some of their profits. But I would certainly recommend that people and investors look at their goals, their risk profiles. What are they going to do with the money that's going to come out? As long as they are clear about all of that, only then go ahead and say, okay, I must redeem across the board.
Okay, well, you should be having a plan really of what you're going to do with your the money that you are redeeming from these equity mutual funds. Yes, markets are high and you can be tempted to take some money off, but then have a plan of what you're going to do. The other case is, of course, if your goals are coming closer, then that's another reason why you should consider redeeming your mutual funds. Okay, large cap funds have actually seen more redemptions, even small cap funds, as perhaps investors were perturbed by the correction seen there. So how are you looking at small and mid cap funds right now, Mr. Navlakhi? Because, what's interesting is that mid cap funds have actually seen net flows coming in, but large and small caps, we've seen money being taken off right now. So what would be your strategy, especially for a new investor? Where should they put their money? Large caps, mid caps and small caps, and also for existing large cap, mid cap, small cap fund holders, what do you recommend?
Yeah, so I think it's typically when you're investing in equity, you have to keep in mind longer time cycles to get the returns. So if I'm investing in a large cap type of fund, blue chip stocks, then typically a 3 to 5 year cycle is the time over which I will truly sort of generate my returns. Once I move into mid cap, they tend to be a little more volatile, and therefore you need to give them 5 to 7 years. When you go to small cap, you possibly need to give them 7 to 10 years time horizon for you to realize your sort of gains. So we must understand that small caps are small caps because they have not been recognized by everybody, by all market players. So the blue chips are the top names that everybody has heard of. So there is no real discovery to happen. And there are 100 stocks which are defined as large cap. There are 150 stocks defined as mid cap. When you go to small cap, everything beyond the 250 are small cap. So the basket from where I will pick winners is much, much larger. And therefore, selection of those stocks become very, very important. So keep that in mind before you determine how you need to allocate. The second thing is you asked about existing investors. Now, an existing investor has seen very good returns in the market over the last 1 year. And till a few days ago, the small cap index had given double the returns of a large cap index. So while a large cap index had given 45%, 50% type of return, in small cap, you had more than 100% return a little while ago. And that, of course, was on the back of falls that had happened in the prior 2 years. So your allocation between large cap, mid cap, small cap needs to be thought of, almost like constructing a building. So there is a foundation which needs to be strong before you decide whether you're going to build 2 floors, 5 floors, or 20 floors in the building. So that core and the foundation really needs to be large cap. So one would recommend that, a larger portion of your investment is in that core part of portfolio, and then to generate that little extra return with the quantum that you have available for longer periods of time, that's when you allocate to mid cap and small cap.
All right. Okay, understood. I want to talk about some more, fund categories where we are seeing a lot of interest. One of them is the Flexi Cap Funds. Look at the momentum over there. Of course, the net inflows has also been further egged on because we have had a few NFOs in that category. But that, the fact that mutual fund houses are launching NFOs is because also they believe that investors have a big appetite for this. What's your take on Flexi Cap Funds? Because, there's no clear category that, okay, this belongs to large cap, mid cap or small cap. They're free to invest across market caps. So how do you view this fund category in terms of its riskiness, its suitability as well for investors with different risk profiles?
Yeah, and I think the first thing is that fund houses are launching NFOs because investors are having the money to invest, and therefore they are trying to attract them to invest through an NFO route. In the Flexi Cap funds, I think they are really for more sort of educated, more mature investors or investors who are using a financial advisor. The reason is that the Flexi Cap fund really leaves each of the fund managers free to decide what quantum of their money needs to be in large cap, what needs to be in mid cap, what needs to be in small cap, and to move things around within those different market capitalizations. Now, unless you have a really well-equipped fund manager, a very well-equipped team, a bunch of analysts within the fund house, you might not get these sort of calls correct as to where your weightages should be. So I think it is really only for people who understand this element. Some of the Flexi Cap funds have even started incorporating international exposure within their sort of basket, and therefore give you that little feel that, apart from just vanilla ice cream, there's some, chocolate sauce and a cherry also on the top. So will that help in terms of my getting some exposure internationally? So those are sort of different ways by which I think Flexi Cap fund managers are attracting investors to come in. I think you should just take it with a bit of caution because, as I mentioned, in the last 1 year, if my small cap return is double that of large cap, any Flexi Cap fund which has had more weightage to small cap will show much, much better performance than a fund which has decided that, no, I'd rather have a larger component in large cap. So be careful being swayed by immediate returns to decide whether this is a good Flexi Cap fund or not.
All right. Okay, I want to talk about the fund called Balanced Advantage Fund because, of course, over here as well, because we had the SBI Balanced Advantage Fund, which was launched, and boy, did that one garner some massive flows, almost 12,000 crore rupees. But even if we remove that, there is still, compared to all the other equity and debt mutual funds, a good amount of net investor interest in balanced advantage funds. Now, right now, as we speak, Mr. Navlakhi, the markets are just about hovering near their record high levels. Debt funds as well at this point of time, there is, that thing that, okay, yields may start going up, only up from here on. So, given the scenario, especially given that, you don't know where to invest and how to put your money, is this a good place to start off, balanced advantage funds?
I think balanced advantage funds have the advantage, and that's why I think the word in their name, that they are able to move, their equity allocation up and down based on just market valuation. Each of the balanced advantage fund have slightly different ways by which they determine whether markets are cheap, expensive, moderate, etc. But they have formulas which are sort of set. And based on the formula, automatically the allocation of equity sort of increases or comes down. So to that extent, they remove the behavioral bias, where typically as an advisor, when markets are really down, let's take March of 2020, and you had a really sharp fall, is when I would really come up to you as an investor and say, hey, this is a good time for you to invest. The markets have fallen 30% from the top. But if you remember that time, there's a fair amount of fear, and you say, no, hang on, even though I have 100 more rupees to put in for equity, okay, fine, since you're telling me so much, I'll put 10 rupees out of that. So I'm not really taking advantage of the asset class I need to be in. Now, these balanced advantages funds did really well during that time, because when the markets fell in March 2020 and by April, they were at almost 90% allocation in equity. And they really captured most of the upside that was there in the market. However, their formula told them probably by October, November, that means fairly early, that the markets are, starting to be a little more expensive. So we should reduce our allocation. So these are funds which don't give you the entire equity upside, but they give you like a debt plus type of return. So you should get low double digit type of returns over a long period of time. And that's why I think this is attracting people, especially first time investors, because here I'm not, totally dependent on the advisor or the timing of putting in a lump sum at one go, all in equity.
Okay. I want to also, not sticking it with then about equity funds, but I also want to talk about debt funds, where again, one category that's really catching my attention is the floater funds. Almost net inflows of close to 10,000 crore rupees in this one. Is that a good way to invest in debt funds right now, considering the fact that many are expecting that interest rates will go higher from here on?
Yeah, I think it's a question of where your view is in terms of interest rates. So if interest rates are expected to go higher, the logical thing to do is to get onto floater type of funds, because they will help to sort of hedge that sort of movement in interest rates. The other thing you would do is to stay with funds which have a lower duration, because then the impact of that higher interest rate is much lower and you are sort of better off. Of course, the rates of return for these type of funds is not really very high. But just because you want to play that interest rate game, I think the floater fund is good. My guess is that if you do a little bit of deep dive, a lot of that money in the floater funds could possibly be institutional money and not necessarily retail money. It could be high net worth individuals and institutions. So yes, I think that's a good way of playing the debt game for the time being, if you do believe that interest rates are going to go up.
Okay, all right. So that's got to do with how to go about investing in debt funds. Let's do one thing. Let's take on board some questions and queries from our viewers then. Remember, folks, you can connect with us on our email address, themoneyshow@etnow.tv. Let's take on board some questions we've already got. We've got a question from Raghu, who says, I'm 58 years old. I'd like to shift from fixed deposits to the Axis Focus 25 and would like to draw 5% every year post the third year onwards through SWP on a monthly basis. While SWP, when I'm doing my SW calculation, I can see capital appreciating over a period of 7 years. Please advise. Okay, so you know what, let's look at it this way, that he's got an FD, he wants to put it in Axis Focus 25, and then after 3 years he wants to withdraw 5% every year. What's your take? Is this a good strategy for Raghu? Though mind you, he's not mentioned what are his other investment strategies, but let's assume this is the only thing right now that he has as his financial plan.
Yeah, so first and foremost, he has to keep in mind that you're moving from a safety to a aggressive sort of investment, because you're going away from fixed deposit and putting the money in equity. I know you have looked at a calculator and seeing that, capital appreciates over a period of 7 years. And this, mind you, obviously has happened based on past data. There's no guarantee that past data is going to replicate itself. So first and foremost, are you open to taking that extra risk by investing in equity? Second, so look at your overall risk profile, etc. The second thing is that I don't know the quantum of money, but I would not, even if I was to follow this strategy and I'm okay with the risk, I wouldn't put all my money in one particular scheme because we don't know how this scheme is going to perform over the next 3 to 5 or 7 years in future. You have known that this is what has happened in the past. Your other question saying that you're wanting to do this for capital appreciation, I'm not very clear, because capital appreciation, you let the money stay in a fund and let it grow. But I'm guessing you require some income requirement, which is why you're saying you want to draw 5% in a year after the third year onwards. So you might, if you dealt with an advisor, be given other options other than this route to meet your income/retirement requirements. So that's my sort of overall take on this.
इंडिया खेल रहा है तो देर किस बात की? ज़ूम बॉलीवुड तंबोला खेलिए, रोज जीतिए बड़े से बड़े प्राइजेस सिर्फ ज़ूम पर।
एंजल ब्रोकिंग इज नाउ एंजल वन। पर क्यों? क्योंकि एवरीवन डिजर्व्स मोर स्पीड। एंजल वन पे क्विक अकाउंट ओपनिंग के साथ स्टॉक मार्केट में इन्वेस्टिंग शुरू करो। एंजल वन, आगे बढ़ने का स्मार्ट सौदा।
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.